Welcome, curious minds, to another deep dive. Today we're tackling a figure that's, well, truly eye-popping. The Congressional Budget Office, the CBO, estimates that tariffs could reduce the U.S. deficit by an astounding $4 trillion over the next 10 years. $4 trillion. I mean, that sounds on the surface like a massive financial win for the country, doesn't it?
It absolutely does. It's a headline grabber, for sure.
But, as with most things in economics, the headlines often hide some deeper truths. So we're going to pull back the curtain on this projection and really dive into the broader impact of tariffs.
And to do that, we've got some interesting perspectives.
Exactly. We'll be looking at insights from an economist professor at the University of Michigan, Justin Wolfers, and hearing directly from a small business owner, Jeremy Land. He's the CEO of Fontana Forni USA, a company that imports those really high-end pizza ovens from Italy.
Right. So we get the academic view and the real-world business view.
That's the plan. Our mission today is to unpack this whole complex financial landscape, try to clarify who actually pays for these tariffs, and understand what this means for you, the American consumer, and also for businesses trying to navigate these policies.
Going beyond just the big numbers.
Way beyond. Is it truly a windfall for the nation, or is it something else entirely? Okay, let's unpack this, because $4 trillion, that figure certainly makes you sit up and pay attention.
It's definitely a number that captures attention, yeah. And you're right to highlight the CBO's projection, that potential $4 trillion cut in the federal deficit over 10 years. That works out to about, what, $400 billion annually?
Huge numbers.
Huge. And this is exactly the kind of figure President Trump has previously called a financial windfall for the country.
No, okay, but Professor Wolfers, our economist, he immediately pushes back on that term.
He does. Very clearly. He reframes it right away, stating quite plainly, it's not a windfall, it's a tax.
Okay, explain that distinction. Why is that so important?
Well, it's fundamental, really. A windfall, implies some kind of unexpected gain, often from outside, like finding oil or something. But when the government raises revenue from its own people, from citizens or businesses within its borders through mandatory payments, well, that's a tax.
Right. It's generated internally, not some bonus from abroad.
Precisely. So while the CBO's math might add up to $4 trillion on paper, understanding its actual economic nature as a tax is crucial from the get-go.
That's a really critical clarification. A tax, not a windfall. Got it. But then Professor Wolfers throws, another layer of skepticism on the CBO's projection itself. It assumes these specific tariff rates will last all the way through 2035. He says there's no chance of that. Why? Why so certain?
Well, it comes down to how tariffs work and how businesses react. The CBO makes robust projections, sure, but they're based on current policy remaining static. Wolfer's point is that tariffs are designed to change behavior. They push companies to maybe move production or find new suppliers.
Ah, so the policy itself creates incentives to undermine the policy's long-term revenue.
Kind of, yeah. The idea that these exact tariff rates would just sit there for over a decade, while businesses make huge long-term investment decisions based on them. He finds that pretty unrealistic. He argues the tariffs themselves are just very likely to change or be changed by a future administration way before 2035. That makes projecting stable revenue for that long really speculative.
Okay, so right off the bat, we're questioning the foundation here. It might be a tax, not a windfall, and the $4 trillion figure itself might be built on shaky long-term assumptions. But the next big question for you listening is really fundamental. Where is this money really coming from? President Trump promised foreign companies or governments would pay for these tariffs. Is that what's actually happening?
Yeah, this is where the economic analysis often bumps up against the political promises.
Yeah.
Let's use Professor Wolfer's example. It makes it really clear. Imagine Best Buy, an American company, imports a washing machine from, say, Korea.
Okay.
That washing machine arrives at a U.S. port and it sits in customs.
Yeah.
It cannot leave that customs warehouse until Best Buy, the American importer, writes a check to the U.S. government for the tariff amount. So step one, it's explicitly an American company paying this tax.
Okay, so Best Buy cuts the check, not the Korean manufacturer. That's straightforward. But then does the Korean company maybe lower its price to Best Buy to kind of absorb that cost and stay competitive?
That's the key question, right? Do foreign suppliers eat the cost? And to figure that out, economists look at something called the import price index. It measures the price of goods before the tariff is added.
And what does that index show?
Wolfers points out something pretty telling. The index has not fallen a penny. Think about that. If foreign companies were really paying the tariff, you'd expect them to cut their pre-tariff prices, wouldn't you? To help Best Buy out.
Yes, you would.
But the data shows they haven't. which directly contradicts that promise that foreigners would pay. Best Buy's cost for that washing machine just went up by the full tariff amount.
And when Best Buy's costs go up, well, what happens next?
Exactly. What happens next? If the import prices didn't drop, Best Buy's costs are higher. And any business facing higher costs, well, usually they have to pass that along down the line, meaning eventually they jack up the price, as Wolfers puts it. The price you pay for that washing machine goes up. So yeah, an American company pays the tax initially. That might hit their profits, which impacts investors, maybe your 401k, if it holds Best Buy stock. But ultimately, a lot of it lands on you, the American consumer, through higher prices. His conclusion is pretty stark. It's a tax on Americans being paid by Americans.
Wow. Okay, so the economic reality seems quite different from maybe the common perception.
Yeah.
The cost really does seem to circle back to us one way or another. That's a fascinating disconnect. But all right, that's the macro view from Professor Wolfers. What does this actually look like on the ground, for a real business trying to deal with this day to day?
Right. Let's shift gears to that micro impact.
Yeah, let's bring in Fontana Forni USA. We mentioned Jeremy Land, the CEO. They import these high-end outdoor pizza ovens from Italy. Been doing it since 1978, working closely with the Italian family that makes them. They have an exclusive deal. And Jeremy's been right in the thick of navigating these tariffs.
And he describes some pretty profound challenges. First off, just the sheer complexity and uncertainty. He says even the customs brokers, the people whose job it is to know this stuff, are not even exactly sure what the procedures are.
Really? The experts aren't sure.
That's what he reports. It leads to this lack of transparency, lack of predictability. It makes it incredibly hard for them to plan anything. Inventory, cash flow.
And it's not just one simple tariff rate they face, is it? It's more complicated than that for his pizza ovens.
Oh, much more complex. He explains they face, first, a standard 15% EU tariff. That's a general import duty on certain goods from the EU. But then on top of that, there's a second steel tariff. This is one of those targeted duties, maybe meant to protect U.S. steel, and it's a whopping 50% of the cost of the steel used in their ovens.
50%. Just on the steel component.
50%. And he gives this just shocking example from back in June. 2 of their ocean containers full of pizza ovens got hit with combined tariffs that totaled over 80%.
Over 80% tax on arrival. I mean, that's hard to even fathom for a business. A small cost increase can hurt, but 80%. What does that do to a business like his, the uncertainty, the cost?
Yeah, it creates just immense financial strain. He says this kind of unpredictability, these huge potential costs, it ties up cash massively. And it makes it hard to plan their inventory. These are expensive items coming on ships. Planning is critical.
So how did they handle it? Did they just raise prices by 80%?
Well, no. He says Fontana Forni absorbed these huge costs for as long as they possibly could. They're still absorbing some, actually. But eventually, something had to give. He says August 1st was our first price increase in years. They raised prices by 10%.
Only 10% after facing costs like 80%. They must be eating a lot of that.
It sounds like it. And he confirms the tariff burden falls squarely on them, Fontana Forni USA, the importer. And then, some of it has to be passed to customers. He mentions they have the absolute best of terms with their Italian supplier, meaning there's just no wiggle room there to get the supplier to lower prices and share the pain. It all lands here.
So if Jeremy Landor could talk directly to President Trump about this, what would his message be? Is it just get rid of the tariffs?
It's actually more about the process, the practicality. His message is really a plea for clarity and predictability. He says, basically, sure, we understand the tariffs, but really there needs to be transparency. There needs to be predictability. He continues, the sudden changes really disrupt our business, and if there was just clear guidance, it would really, really help us out. He's not necessarily fighting the policy itself in that quote, but the chaotic way it's implemented. He just wants a stable environment to run his company.
Wow. So for someone just trying to run a business, it's navigating this incredibly unpredictable landscape, absorbing massive fluctuating costs, and then, ultimately having to pass some of that cost on to you, the customer, just to, keep the lights on and maintain the quality of their product. It really doesn't sound like a windfall for American businesses like his. It just highlights the real-world friction. Okay, let's pivot back then to that huge $4 trillion figure. If this revenue is being collected, even if maybe not for the full 10 years, where does that money actually go?
That's a really important question, especially given some of the past rhetoric around this. You might remember President Trump at one point considered a tariff rebate check for consumers.
Oh, right. I remember that floated around, like
Yeah.
giving the money back to offset the costs.
Exactly. And the Treasury Secretary at the time talked about being laser focused on paying down the debt with tariff money.
So did either of those things happen? A rebate check or significant debt reduction specifically linked to tariffs?
Well, Professor Wolfers calls the rebate check idea crazy. He points to previous promises of saved dollars or rebate checks that just never materialized. He seems skeptical it was ever a serious plan.
Okay, so no rebate check. What about paying down the debt? Where does Wolfers say the money is effectively going?
His analysis is much more direct and pretty stark, frankly.
Huh?
He states quite pointedly that the funds from these tariffs, that $400 billion a year or so, have already been spent.
Spent on what?
According to Wolfers, spent by Republicans giving tax cuts to rich people. He suggests looking at the bigger picture. Essentially, one set of taxes has been swapped for another.
Oh, so.
Well, historically, the U.S. had higher income taxes, particularly on high earners. Those have been significantly reduced in recent years. Wolfers argues that tariffs are now effectively filling that budget hole created by the income tax cuts.
So trading income taxes for tariffs, what's the implication of that trade?
The crucial implication, Wolfers argues, is who pays. Tariffs function effectively as a sales tax because, as he says, all of us buy imported stuff, and therefore all of us are paying these tariffs. Income taxes, especially at the higher brackets, fall more heavily on the wealthy. Sales taxes, or taxes that function like them, tend to hit lower and middle-income people harder as a percentage of their income.
Because everyone buys imported goods, regardless of income level.
Right. So his conclusion is that this swap means the overall tax burden has shifted from the rich to the working middle class. It's not just about the amount of money raised, but about who is providing that money to the government.
So it's almost like moving from a more progressive tax system where higher earners pay a larger share towards something more regressive, where the cost of government funded more through consumption taxes that everyone pays, potentially hitting middle and lower incomes harder.
That's precisely the economic argument Wolfers is making. The $4 trillion projection isn't just about the amount. It raises fundamental questions about the structure of the tax system. Who benefits from the tax cuts, and who bears the load of the tariffs used to effectively pay for them? It paints a very different picture.
Okay, as we wrap up this deep dive, let's quickly recap the key insights from today. First, that huge CBO projection, $4 trillion deficit reduction. While attention-grabbing, it rests on assumptions like tariffs lasting unchanged until 2035 that our expert source, Professor Wolfers, finds pretty unlikely. And critically, he reframed it. It's not a windfall, it's a tax.
Second, who pays that tax? Despite promises otherwise, the economic evidence, like the import price index, strongly suggests it's Americans. American companies pay first, like Best Buy paying at the port. But since foreign suppliers aren't cutting prices, those costs largely get passed on to you, the consumer, through higher prices.
Third, we heard from Jeremy Land at Fontana Forney USA about the real-world impact. The complexity, the sheer unpredictability, those shocking tariff rates over 80% in one case. It disrupts businesses, ties up cash, and forces price increases, even if they try hard to absorb costs. His plea was really for transparency and predictability.
Yeah, that really brought the policy down to earth. And finally, where does the money go? The economic analysis from Wolfers suggests the tariff revenue hasn't primarily gone to debt reduction or rebates, but has effectively offset tax cuts that disproportionately benefited the wealthy.
Which leads to that crucial point. The tax burden seems to have shifted.
Yeah.
Because tariffs act like a sales tax on imports that everyone buys, it means the working and middle class may be bearing a larger share of the overall tax load than before.
Exactly. It's a shift in who funds the government.
So this deep dive really reveals that a policy that might seem simple, tax imports to raise money or protect industry, has these incredibly far-reaching, complex implications for all of us. You see it in the price of a washing machine or a pizza oven or countless other goods. You see it in the struggles of businesses trying to navigate uncertainty. And it makes you wonder, doesn't it? If tariffs are effectively functioning as a kind of national sales tax on imports, one that might disproportionately affect average Americans, what are the broader conversations we should be having about how our government funds itself, who benefits from the choices made, and who ultimately carries the weight? Something to think about. Thank you for joining us on the deep dive. Until next time, keep exploring, keep questioning, and keep getting well informed.